Hello everybody and welcome back. And in this lesson, we will talk about the investment tax credit after the Inflation Reduction Act. ITC is an investment-based tax credit, and it applies to solar, wind. It also extends to standalone energy storage projects and interconnection equipment. So, before the Inflation Reduction Act, the standalone energy storage projects could not apply for the investment tax credit. It would only qualify for the investment tax credit if it were part of a solar renewable energy project. However, now standalone battery projects with capacity of 5 kilowatt-hour or higher are eligible to get the investment tax credit. The ITC value under the Inflation Reduction Act ranges from 6 to 70% of eligible project costs. So the base rate is 6%, and then the ITC rate can increase up to 70% if certain criteria are met. If we assume that our ITC rate is 30% and our project cost is 100 million, then we can claim 30 million ITC. ITC is earned upfront when project is placed in service, which basically means that we can claim ITC at the end of the quarter when project was placed in service. However, note that this will depend on the company's tax situation. So, some companies will only be able to claim ITC at the end of financial year, while others can claim the ITC at the end of the quarter when the project was placed in service. And this is relevant for the partnership structures where you have a tax equity investor who will get most of the ITC. If tax equity can claim ITC only at the end of the financial year, then this will be reflected in the financial model, and obviously this will negatively impact the project returns. When we claim the ITC, we have to reduce the depreciation basis by half of the ITC claimed. So, if we go back to our previous example where we could claim ITC of 30 million, then this would mean that we have to reduce our total depreciation amount by 15 million. So 30 million times 50% is equal to 15 million. ITC is subject to recapture during the compliance period of 5 years from the placed in service date of the renewable energy project. Recapture means that some or all of ITC has to be given back if certain rules are breached. Changes in ownership, asset disposal, or a project no longer qualifying as an energy facility, such as when it stops producing energy, are reasons for ITC recapture. ITC recapture decreases over time. If recapture happens in the first year, we must return 100% of the ITC. If it happens in the second year, we only need to return 80%. By the fifth and final year, we only need to return 20%. ITC phase out follows the similar schedule as PTC. We're not going to repeat the phase out schedule here, so if you missed it, please refer back to the PTC lesson. Let's now quickly review how ITC is calculated. In this example, we assume that our total construction and equipment cost is 40 million, and out of this 40 million, 20% is not eligible for ITC, and therefore the ITC eligible cost is 32 million. That is 40 million times 80%, which is equal to 32 million. Let's assume in this example that our ITC rate is 30%. Next, we have to multiply the ITC rate of 30% by ITC eligible cost of 32 million to get to an ITC amount of 9.6 million. We've got the ITC amount, and next we will calculate the reduction in our depreciation basis because of ITC. So remember that the depreciation reduction will be 50% of the ITC amount claimed. Therefore, we will multiply 50% by the ITC amount of 9.6 million, which will give us 4.8 million. Now that we have reviewed the ITC after IRA and completed our ITC calculation example, let's quickly review the key points of Inflation Reduction Act. The Inflation Reduction Act was passed on August 16, 2022. Under the IRA, both solar and wind can elect PTC or ITC. The ITC value ranges between 6 and 70%, and the PTC value ranges between 0.6 and 3.6 cents per kilowatt hour. Next, the standalone battery storage with capacity of 5 megawatt hour or higher can claim ITC, and the interconnection equipment with capacity of 5 megawatt or smaller can also claim ITC. There's one more important point that we haven't covered yet, but it's very significant. I will address this in more detail in a separate lesson, but the key idea is that the tax credits can now be sold to a third party for cash. This is a major development because it could mean that we no longer need tax equity partnerships. If so, this might eliminate the complexities often associated with structuring those tax equity deals, which is a significant advantage. And finally, we also learned about the phase-out scheduled for ITC and PTC. The phase-out happens either in 2032 or when emission from electricity production is lower than 75% of that of 2022.